Hello everyone, my name is Ali Blalani. I'm a director with MSKC and Associates. I'm happy today to give you all an update on regulatory matters. So what we will be covering today is some of the important regulatory updates over the last couple of months from some of the major regulators of India. Let's begin. So today we will be covering updates from the Ministry of Corporate Affairs, the SEBI and the Reserve Bank of India. Let's begin. The first amendment that we have is from MCA requiring it to collect data as regard the beneficial owner of the company. Now, this mechanism was already well in place through the Companies Act and the rules. The beneficial owner was required to declare himself as the beneficial owner. The company was required to make the declarations to MCA and file the forms. But MCA has now gone one step further to strengthen the mechanism. They now want every company to designate the person who will be responsible to inform them regarding the beneficial owner of the company or any other authorized person who they ask, and to extend the necessary cooperation to that person. So MCA now has a more better mechanism and they have a person to take hold of if they need further clarification on the beneficial owner of the company. These amendments are now applicable from 27th of October 2023. Another amendment that came up from the MCA is a requirement to dematerialize the securities. Now, we are all aware that for any public to raise any convertible securities by the company, you need to issue them in dematerialized form. So this amendment that came from the MCA is for securities issued prior to commencement of the Companies Act and which have not been converted as on date. So the requirement is that within a period of 3 months, those companies need to inform the MCA in Form PAS 7 the list of their outstanding share warrants. And then simultaneously, within a period of 6 months, they need to have those persons, the bearer of the share warrants, surrender the share warrants to the company and which can be reissued to them in dematerialized form. Now, if they are not able to surrender the share warrants to the company, then the company has a right to to convert the share warrants by themselves and transfer them to the Investor Education and Protection Fund. So this is definitely an important amendment for those having share warrants issued but have not yet converted them. The provisions to list securities in foreign jurisdictions, I think this is one of the most awaited sections in the Companies Act, which enable the companies and will enable us to tap foreign markets. Now, in 2022 itself, MCA did amend Section 23 and inserted provisions for allowing certain companies to issue certain securities, which they would specify, to be listed on the foreign exchanges. But there was not much movement on this section for quite some time. On 30th of October, MCA issued the notification stating the effective date for that provision is 30th of October itself. Now, along with releasing and enabling provision to companies to approach and list on foreign stock exchange, it also granted authority to central government to even exempt certain class of public companies from this amendment to Section 23. Now, while these are in place and companies can approach foreign markets, but MCA is yet to specify the class or the classes of the companies where the securities, can fall under these revised provisions. So, while we are, yes, the doors to foreign markets are open, but there's still some work to be done as companies move towards enabling this provision. Okay, here's another enabling provision from the MCA that, of course, makes it easy to do business in India as well, is that it allows us to hold the AGMs and the extraordinary general meetings through a video conferencing mode or any other audiovisual means that we prefer. These provisions were earlier allowed till the 30th of September 2023, and MCA, of course, proactively has come out on 25th of September itself to now extend this provision till 30th of September 2024. Now, it's interesting to note that as MCA aligned itself, SEBI also aligned itself with the similar provisions under the SEBI listing regulations. Now, SEBI also has exempted the listed companies from sending the hard copies of the statement of sale in futures, which is required to do, and that has also been extended till 30th of September 2024. So it aligns with the requirement of AGMs happening online or through audiovisual means, and hence doing away with the need for hard copies being sent out. Additionally, listed companies, of course, if they are doing their AGM through electronic means solely, they are also exempt from the requirements of sending out proxy forms under Regulation 44.4 of the listing regulations. Obviously, because it is being done electronically and you can reach out to all the members this way. So, this is, of course, enabling amendment from MCA to allow businesses and companies to function smoothly going forward. Let's look at the next ones. We now come to certain amendments made by the SEBI in its act and its regulations. Now, SEBI introduced several changes, but one of the important chapters that it has brought into the Listing Obligation Disclosure Requirement Regulations 2015, as we commonly know as the listing regulations, which is the enabling regulation to list your securities. They now have inserted a specific chapter with complete guidelines and details, Chapter 6A, on voluntary delisting of the non-convertible debt security or the non-convertible redeemable preference share. Earlier, there was no such provisions in the listing regulations, so I think this is a welcome move. The framework does specify to whom it would apply, of course. So there are certain criteria of listed entities who have only issued specific securities, and if they meet those particular criteria, such as public issue and stuff, then this framework would not apply to those securities. However, it would be applicable to all the other non-convertible debt and securities and preference shares. And the chapter basically has complete details on making applications to stock exchange, obtaining the no objection or no objection from the debenture trustee, getting approval from the stock exchange, and the final delisting process. So comprehensive guidelines are there now for companies to follow to already delist the securities. Okay, in June 2023, I think everyone remembers SEBI's major amendments to the listing regulations, which really disrupted and brought about it upped the game of transparency and communicating with stakeholders by listed companies. So one of the interesting amendments that we had in June 2023, which were announced, were that the market rumors that come out have to be confirmed or denied, or if or even if a company is not able to explain it, they have to make the public statement of that fact for listed companies, and they went by um, threshold by threshold approach to bring in this requirement for listed companies. So it was for top 100 listed companies which needed to confirm or deny market rumors from 1st of October 2023, and the top 250 listed companies would require to confirm or deny market rumors from 1st April 2024. So SEBI has sensed, I think, difficulty in applying these provisions. Of course, when we have last discussed in the previous many sessions, to enable this kind of a framework where a company can immediately identify market rumors, get into the facts and the circumstances of it, and be able to make a public statement to either accept the rumor or deny the rumor, needs a certain amount of a framework, a certain mechanism in place. Only then can companies confidently comply with this requirement. So I guess SEBI has seen the difficulty in the applying these provisions so early. So they have allowed an extension. So for the top 100 listed entities, the requirement will now begin from 1st February 2024 instead of 1st October 2023. And for the top 250 listed entities, the obligation will commence from 1st of August 2024, which was earlier 1st April 2024. So I think giving companies sufficient time to set up the mechanism to identify and confirm market rumors. Now, this is one of more interesting amendments. I would not call it an amendment. It is a proper framework for large corporates that SEBI has come up with, and it is issued under the issue and listing of non-convertible securities. the NCS regulations, as we'll call it going forward. Now, in accordance with these regulations and the master circular, the stock exchanges will identify large corporates, and the large corporates are now mandated to raise a minimum of 25% of the incremental borrowing during the financial year by issuing a debt security. Now, this obligations plans over a continuous block of 3 years starting from financial year 2022. Now, to streamline the business practice and foster the growth of corporate bond market, the SEBI actually issued a circular in October 19, revising the framework for large corporates concerning the raise of funds through debt securities. Now, earlier in August 2023, there was a concept paper taken out to basically suggest amendments in these regulations because of the difficulties being faced in the market. Now, let's take them step by step, and by the end, I think we will have a holistic understanding of how these provisions are to be followed. Now, the framework is actually applicable to all listed entities except for the scheduled commercial banks. So the listed entities that are now mentioned to whom this will be covered is those who will fulfill the criteria on the last day of the financial year. So, which could either be 31st of March or it could be the 31st of December. We'll talk about those year end and the thresholds on the next page. Now, to whom is this applicable? Now, we call them large corporates. Now, there is certain criteria determined to identify large corporates. So, some of the criteria is laid down in the regulations is that it has to be a listed entity. It needs to have a borrowing of more than 1,000 crores. Earlier, this requirement was for 100 crores, but now it is that they've revised it to 1,000 crores, and they should have a credit rating of either AA or AA plus or AAA. So these entities would be qualified as large corporates, and stock exchange will make disclosure of their information or their qualification as a large corporate on their websites. So let's get at what exactly they need to do. So the large corporate, when it gets identified basis the criteria, they should be raising at least 25% of the qualified borrowing, which was early termed as the incremental borrowing for the year, by issuing a debt security in that financial year, subsequent to the financial year in which is identified as a large corporate. So once identified as a large corporate, they need to now move forward in the next year. Whatever funds that they raise, 25% of those funds should be raised from debt securities. This is basically what the provision says. Now, they've specified certain incentives and they've specified certain disincentives if these regulations or this criteria of 25% is not met. So let's look at the incentives enjoyed by large corporate by following the SEBI regulation here. So if at the end of 3 years there is a surplus in the requisite borrowing, that means if the company has raised the minimum 25% through debt securities, and there is in fact it has done excess, then they will have certain incentives. What are those incentives? One, a reduction in the annual listing fee pertaining to the debt security or the non-convertible redeemable preference share, and a credit in the form of a contribution to the core settlement guarantee fund of limited purpose clearing corporation. So if they meet the minimum threshold, there is an incentive in the way of better financing and cost saving. The basis of the computation of the incentive and stuff, all those technicalities are mentioned in the annexure to the circular released by SEBI. Okay, so SEBI also introduced the disincentives, as I said earlier. The disincentive is that if there's a shortfall in meeting the 25%, then the additional contribution will be required to the core SGF fund mentioned earlier, and the manner of the contribution to compute everything that is mentioned in the annexure to the circular. So SEBI has very smartly put incentives and disincentives for complying with these regulations. Now let's look at the methodology, how this will come into place. So the identification of the large corporate will be done by SEBI. They will be doing it based on the financial results submitted on the stock exchange. So for those following the April to March, the 31st March year end basically, they will release the list on their website by the 30th of June. And those following the January to December, basically 31st December year end, they will be releasing the list by the 31st of March. So that's, let's say there is a time period of 3 months. So the stock exchange will also be calculating the incentives and disincentives and would intimate the same to the large corporates. So the very less chance of any of the corporates missing their eligibility and ability to and the benefits available to them for complying with SEBI regulations. Now, this revision, the framework has been revised, so the changes are now applicable from 1st of April 2024 for LCs are following the first March, the March 31st year end, and the LCs following the December year end. Their framework will be effective from 1st Jan 2024. So a question does arise: is what happens to the previous the LCs identified on the previous criteria? So SEBI has brought in an enabling provision that says that okay, listed entities that have already identified as an LC based on the erstwhile criteria in 2020, 21, 21, 22 or 2023 should comply with the requirements of raising 25% of the incremental borrowing by way of issue of a debt security till 31st March 24. So the old criteria and the limit of 25% still stays, and that compliance is required till 2024. If there is a failure to comply with the requirements, the LC should provide a one-time explanation in the annual report for the financial year 2024. Okay, and the earlier circular was having penalties on and annual disclosures regarding the details of the borrowing, and those have been actually been removed. Hence, under the revised framework, there will be no penalties levied on the LCs. So, like I said, they've brought in incentives and disincentives, and the penalties have been removed. This is more for the listed large corporates with 1,000 crore plus borrowing, which need to basically keep their focus open for these to comply with these regulations. Another very important amendment, in my view, that SEBI came out with is to mandatorily require non-convertible debt securities to be listed. Now, so this is an important regulation because when I see this is that going forward, all non-convertible debt securities will be needed to be mandatorily listed. So a new regulation 62A has been inserted for the listed companies and the listing regulations, and that now enables this to process and mechanism to fall into place. How it would proceed is that if a company already has non-convertible debt securities listed, then all the securities that it is proposing to list or issue on or even after 1st of Jan 2024 would all have to be listed on the stock exchanges. Now, they have of course got all the scenarios. If there is a subsequent issue of an unlisted NCD made on or before the 31st of December 2023 and they're outstanding on that date, then those unlisted NCDs also have to be listed on the stock exchange. Um, the third scenario they have got is if it's a listed entity which is proposing now to list the NCDs that it has issued, where either on or even after the 1st of Jan 2024, which are outstanding unlisted NCDs, then they should all be listed on the stock exchange within a period of 3 months from the date of the listing of the NCD proposed to be listed. So what I see here is that there is no scenario now where your NCDs will be unlisted. It will be necessary to list all the NCDs on the stock exchange. Now, this amendment is effective from the 19th of September 2023, and there are certain exemptions given for NCDs that need not go for the mandatory listing. So, one are the bonds issued under Section 54 EC of the Income Tax Act 1961. The NCD is issued pursuant to an agreement between the listed entity and the multilateral institutions. So those NCDs need not go for mandatory listing. And of course, any NCDs which have been issued by a company pursuant to an order of a court or a tribunal or on account of a regulatory requirement stipulated by a financial sector regulator like let's say RBI or IRDA. So if NCDs have been issued pursuant to their instructions, there is no need to go for the mandatory listing of these NCDs. Now, of course, if a company now is going to propose listing of its NCDs, it's necessary to make all the disclosures with relating to the NCDs, all the key terms, the privileges enjoyed by those securities, they all have to be disclosed to the stock exchange immediately. All right, so those are some of the big amendments from SEBI. Now let's take a look at some of the amendments from the Reserve Bank of India. All right. This is an amendment that has come specifically for the board of directors of banks. Now, we take a step back to see what happened in April 2021 when the corporate governance norms were issued, which specifically focused on appointment of directors and constitution of the committees. Now, those regulations were quite comprehensive. They laid down a lot of instructions for the chair, the meetings, the board, the composition, the tenure, remuneration, and they also did mention appointment of the whole-time director and the criteria and all stuff like that. But what RBI realized over a period of time is that there is complexity in the banking sector, and there is a gap in having an effective team in place at once. And also it was impacting the succession planning in banks. So in October 2023, RBI has come up with a specific instruction for all banks to ensure that they have at least two whole-time directors at any time, any point of time, including the MD and the CEO on their board. This is now requirement for all banks to have this mechanism in place to ensure that these appointments are happening and the board is always, I would say in a word, complete to and does not impact operations. The provisions of these notifications apply to all the private sector banks and the wholly owned subsidiaries of the foreign banks as well, only excluding the payment banks and the local area banks. So, an important mandate for all banks. Banks have to go back to the drawing room if they do not have the mechanism for having this kind of a team in place. They are required to immediately start working, and they are supposed to also come up with a plan and inform the same to RBI. So good decision, good a welcome move from RBI, of course, to in the name of strengthening governance in banks. All right, another important amendment from RBI directly impacting the financial statements of banks is on the disclosure and the presentation of unclaimed liabilities. Now, this was quite settled in accounting as per the the guidelines and the framework prescribed. All the commercial cooperative banks were had to present their unclaimed liabilities where the amount has been transferred because they are unclaimed. The amounts have been transferred to the Depositor Education Awareness Fund already. These had to be disclosed under Schedule 12 contingent liabilities, other items for which the bank is contingently liable. Now, this is now required to be disclosed under the heading Contingent Liabilities Others. Now, this provision basically has come into place to ensure consistency in the reporting of all financial statements of all banks. So it's more clarificatory, and however, it needs to be mentioned, and the bank needs to disclose in the financial statements that the balances of the amount transferred to the DE funds are included under the Schedule 12 contingent liability others, or whether it's included under contingent liability items for which the bank is contingently liable, as the case may be. So complete disclosure is required, and these are all amendments are applicable from for the financial statements for the financial year ending 31st March 2024, which is to come up soon and onwards. So definitely all banks and auditors have to take care of these disclosure requirements. In September 2023, RBI issued a mandate requiring all the regulated entities to display the information of the secured assets which they have acquired under the Securities and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, well commonly known to us as the SARFAESI Act. Now, what is the intention behind this disclosure? I'm sure everyone will appreciate that a public disclosure of such information of the secured assets on a public platform or on the website will definitely give more add transparency and comfort to the stakeholders who are dealing with regulated entities. So this is important for all the regulated entities who are actually the secured creditors as per the SARFAESI Act, and they need to take this information and disclose the information in the format given for all the borrowers whose secured assets they have taken into possession. So this will really help ensure transparency across, and it will allow stakeholders to publicly view the borrowers and what are the assets that have been taken into possession by the entities. So the requirement of this mechanism to come into place is that the RE should first display the list on their website within 6 months from the date mentioned on the circular. So we look at the circular, it came out on 25th of September 2023, and 6 months from there would be 25th of March 2024. And thereafter, this list has to be updated on a monthly basis. That means data will always be live and current on their websites and will be open for public, view and stakeholders observation. So I think this is a great move, done by RBI that will surely go a long way in ensuring transparency in transactions, especially those coming under the SARFAESI Act, which are already under a certain amount of stress. The assets are already under a certain amount of stress. So stakeholders would be well informed now. That brings me to the end of our session today on updates on regulators over the last couple of months. Definitely, regulators are changing in the view in the with the goal to achieve greater transparency and ease of doing business in India. Regulators are moving faster and bringing about enabling changes for corporates and for stakeholders. Interesting for all of us. Let's keep updated. Let's stay updated. It was my pleasure to speak with all of you today. Until we meet again next time, have a good day.